Hello friends, till now we have studied what is finance, what is financial management and what are the importance of financial management. Now let us move further. Now the topic is objectives of financial management. So we know that normally the profit is generally required in any business, because without profit normally the respective enterprise cannot survive, just like man cannot survive without food. So in such case enterprise cannot survive without the profits. So the intention here is to maximize the profits, maximizing the profit. Now what is profit now? Profit is generally revenue minus cost. That is, one side we look at normally which are the source of income, second side we look at normally what are the expenses. Cost means expenses. So revenue minus cost is considered here, one side. So that will lead to the profit for the enterprise. So most important to note here is normally the organization has got two types of profits. The first one is called as gross profit, second one is called as net profit. A gross profit is normally those profit which is arrived where we don't consider the deductions, like normally the depreciation, like your amortization, like taxes, whatever is there. So after deducting all these, whatever is left over is treated as net profit. Remember, gross profit is profit before tax and depreciation, and net profit is profit after tax and depreciation. That is there. So these things has to be noted when look at normally the maximizing profit. It is very important to focus on earning the profits for the enterprise, because profit refers to the bottom line of the business of the company, one side. Maximizing profit means normally the firm has to make the investment in that area, in that project, which is viable now as well as in the future, one thing. Second thing is firm has to cut on its spending. Cut down the spending means cutting down the cost. It has to cut down the cost, avoid unnecessary spending. That is one side. Third thing is it has to improve the product line. Very important thing is improving the product line, focusing on the products. Fourth thing is it has to focus on the market movement, present demand for its product, and presently how best it can perform in the market. That is one side. And fourth thing is normally it should have a long-term vision and long-term focus. Only then normally the profits can be maximized. One part is there. So having maximized the profit, normally the firm can move to the next position. Okay, next position. Second focus is second objective of the financial management is maximization of the return for the firm. Okay, maximization of the return. Maximization of the return means normally again we find that normally the respective returns earned should be increased. So for example, let us discuss it like this. If the firm has got normally the one project yielding 12% returns per year, in the same year the firm will receive an opportunity to get one more project which is giving normally 18% returns per year. Earlier one was giving 12%. Now this is giving, second one is giving 18%. So 18 minus 12, 6% additionally the firm can earn if it makes more investment in the second project, which gives 18%, less investment in the first project, which will give you 12%. So likewise the returns can be maximized. So what is important there is the firm has to focus on opportunities available in the market. Second one is potential of the market, analyze the potential of the market, and third thing is firm has to see that normally how to make use of available opportunity to create the most in terms of maximizing the returns there. The returns has to maximize. Only returns will again help to build the organization. That is there. So that is second focus. Third one is maximization of the wealth. Okay, maximization of the wealth means normally we should know that normally the whatever profit build is only for today, but whatever wealth is built, that is for permanent. That's why the focus should be on long term. The long term decision should be normally to focus on wealth building. So on building the wealth, normally what happens there is normally the finance of the firm continues to multiply, by the virtue of which normally what happens is the firm will be able to create normally again business out business, just like normally the other more, which is normally a retail outlet owned by Aditya Birla Group. So we find that normally its outlets is increasing throughout the India. So which means that normally it is doing well, one side. Second, look at normally the Mahindra. Mahindra is also into automobiles, is not? So nature of business is different. But we find that normally by maximizing their wealth, they are trying to expand their products, increase their products, and then normally they want to again cross-check normally how their products are growing in the market. So they are into now two-wheeler business, they are also into four-wheeler business, they are into tractor segment, they are into trucks. So they are giving competition for Tata in terms of commercial trucks. Earlier commercial trucks was Tata was number one. Today we can find that normally the earlier two competitors. Now we have got 9 competitors in the market, of which the major giant is Mahindra. Okay, that is there. So in such case normally they focus on building the wealth by concentrating into different areas of business, venturing into all profitable segments of the business. That is there. So wealth will lead to assets. Remember that growth of the funds will lead to profits. Profit will build wealth. Wealth will build assets of the firm. That is there. So as a wealth is permanent. When you look at normally the wealth there. How to calculate the wealth built by the enterprise now again? So, the wealth is normally calculated by sum of cash inflows minus sum of cash outflows. Higher the cash inflows, normally again higher is the wealth. The lower the cash inflows, lower is the wealth. Remember that normally the whatever cash flows is there, it should be greater than 0. Only then normally the investment decision should be made in the finance. If it's lesser than 0, it is better not to go with this, because one should not burn one's own finger, or one should not put stone on one's leg. So, most important thing is focus on those projects which will help you to build your wealth. That is very important. Greater than 0 means there is a profit. Less than 0 means it is negative, which means it is loss. Loss making projects should not be accepted by the enterprise. So, this is the third area. Fourth area is corporate governance. Corporate governance indicates those ethical business which is normally used to run the business of the company. Okay, so the one part normally is when you look at normally corporate governance, normally it is based on 4 pillars, that is transparency, accountability, independence and reporting. The books of accounts must be transparent. Dealings of the company must be transparent. That is one side. Its financial dealings must be clear. Second thing is its independence. It must operate independently without any external suggestions, without any external involvement. That is there. Third one is normally the transparency, the accountability. The firm must be accountable in its transaction. It must also do the genuine nature transactions only. That is the third thing. And fourth one is normally called as reporting. Reporting must be authentic. It must be clear. Your financial report should know that normally you are doing a good business. How much return on equity you have earned. How much is return on investment earned by the firm. How much is the return on capital employed earned by the firm. That is ROE, ROI, ROCE and ROA, that is return on assets, should be very, very clear. It must be as per the industry norms. This shows that normally by being ethical in the market, how much the firm has grown in its size, volume and the nature of business, one part. Next focus is on maximizing the shareholders' returns. So, most important thing is when shareholders EPS is maximized, normally you can find that normally the shareholders can be retained for the long run. EPS is measured by net profit after taxes divided by number of equity shares. On the basis of this, normally again when we maximize the returns, EPS increases means the firm, the respective shareholders of the firms are getting better returns. If the EPS is decreasing means normally shareholders return is getting affected. On the other side, normally we can find that EPS and EBIT, they are just like two sides of the same coin. We should also know that normally EBIT, that is earnings before interest and taxes, and EPS, they should go hand in hand. They must also have a proper the proper focus to see that shareholders return is maximized. To sum up, what I can say is the objective of the financial management is initially to maximize the profits, then to maximize the returns, third to maximize the wealth, fourth one is for corporate governance and fifth one is to maximize the shareholders returns. Thank you.